New Zealand capital gains tax, the negative side. The failed New Zealand Labour Party has already started pre-election planning to introduce a capital gains tax if they are elected into being part of the government in 2026. Obviously the Greens and Maori parties are clueless in this department, but they will nonetheless try and jump on the Labour bandwagon. Capital gains taxes offer some advantages, but they also come with significant disadvantages and challenges. Some of the key negatives are as follows. Disincentive to invest. Capital gains tax rates discourage individuals and businesses from investing. Investors will be less willing to take on risk or commit capital if they perceive that a significant portion of their gains will be subject to taxation upon realization. This could result in negative implications for economic growth and innovation. Distortionary effects. Capital gains taxes can distort investment decisions by influencing the timing, composition, and scale of investment activities. Investors may hold on to assets longer than economically optimal or choose investments based on tax considerations rather than their underlying economic merit. Lock-in effect. Capital gains taxes can create a lock-in effect, where investors are reluctant to sell assets with accrued gains to avoid triggering tax liabilities. This behavior can reduce market liquidity and hinder the efficient reallocation of capital to more productive uses. It may also contribute to asset price distortions and market inefficiencies. Complexity and compliance costs. Capital gains tax rules can be complex, particularly when dealing with various types of assets, holding periods, exemptions, and tax rates. Complying with these rules may require specialized knowledge, professional advice, and record-keeping, imposing administrative burdens and compliance costs on taxpayers, investors, and tax authorities. Potential for tax avoidance and evasion. High capital gains tax rates or loopholes in the tax code can incentivize taxpayers to engage in tax avoidance or evasion strategies to minimize their tax liabilities. This may include engaging in tax planning activities, exploiting loopholes, or engaging in fraudulent behavior to underreport or conceal capital gains income. Undermining the integrity and fairness of the tax system. Impact on entrepreneurship and innovation. Capital gains taxes can affect entrepreneurial activity and innovation by influencing the incentives for individuals to start new businesses, take risks, and invest in innovative ventures. High tax rates on capital gains may discourage entrepreneurship and venture capital investment, particularly in high-risk, high-reward ventures where the potential for capital gains is significant. International competitiveness. High capital gains tax rates relative to other countries can make a jurisdiction less attractive for investors and businesses, potentially leading to capital flight, reduced competitiveness, and loss of economic activity. Investors may seek out jurisdictions with more favorable tax treatment of capital gains, undermining domestic investment and economic growth. Overall, while capital gains taxes play a role in generating revenue and promoting fairness in tax systems, policymakers must carefully consider the potential disadvantages and trade-offs associated with these taxes to ensure they achieve their intended objectives without unduly hampering investment, entrepreneurship, and the economic growth. You are unlikely to hear the negative side of capital gains tax from the New Zealand Labour Party because it will diminish their re-election chances. And you will definitely not hear the negative side of capital gains taxes from the Greens or Maori parties, because, quite bluntly, they are actually far too stupid to understand economics. Thank you for listening. Geraint, on behalf of WhangareiTim.